Welcome to this explainer. If you spend enough time staring at corporate balance sheets, that equity section kind of starts to look like a complete black box. Well, today, we're cracking it wide open. We're going to make sense of it all by splitting the accounting into two really simple buckets. First, the inflows, so when a company buys back its own stock. And second, the outflows, when it distributes wealth right back to the shareholders. Let's get right into it.
Here's how we're going to break it down today. First up, the inflow. Then we'll look at the mechanics, followed by the outflow. After that, we'll cover the variations, and we'll wrap things up with a look at the edge cases.
All right, starting off with Section 1, the inflow. Let's cover some Treasury stock basics and rules. So once a company pulls its own shares back into the vault and they become Treasury stock, they go completely dormant. It's like they lose all their superpowers. No voting rights, absolutely zero dividends, and they drop out of your earnings per share calculations entirely. Because repurchasing shares is such a massive deployment of capital, it can't just happen on a whim. It always requires formal authorization from the board of directors.
Now, obviously, regulators don't want companies artificially pumping up their own stock prices, right? So the SEC provides a safe harbor under Rule 10b-18, which puts a strict cap on daily purchase volume at 25% of the average daily trading volume. And this is interesting. If you look at the recent December 2022 amendments, the SEC actually cracked down hard on 10b-51 insider plans. They did this by enforcing these mandatory cooling-off periods that can last up to 120 days, plus new restrictions on overlapping plans.
Moving right along to Section 2, the mechanics. Let's look at the cost method and stock retirement.
Okay, so under the widely applied cost method, the actual accounting for a repurchase is pretty straightforward, but honestly, it's structurally fascinating. Treasury stock is debited, and cash is credited for the amount paid. But here's the kicker. That debit, it doesn't create an asset. Treasury stock is a contra equity account. So you are quite literally burning through company cash to shrink your total equity footprint.
But what happens if the company decides to open up that vault and reissue those shares later on? Well, if they sell them at a premium, above the original cost, cash is debited for the proceeds. Treasury stock is credited for that original cost. And that excess value? It simply pads the additional paid-in capital, or APIC, account.
Which brings us to an absolutely crucial point, the golden rule of corporate equity. You simply cannot generate a corporate profit just by trading your own stock. It doesn't matter if there's a massive surplus or shortfall, you never ever touch the income statement. All those differences, they are completely absorbed within the equity section itself.
Now, sometimes those repurchased shares just aren't meant to see the light of day again. If the board decides to permanently retire them, they are effectively wiped off the books. You strip the par value right out of common stock, and the difference between the cost paid and that par value flows straight into retained earnings. Once retired, those shares are gone forever.
All right, let's pivot to Section 3, the outflow. We're talking cash dividends and timelines.
When we look at a standard dividend timeline, you'll notice something pretty important. Only two of these dates actually trigger a journal entry. The board declares the dividend, boom, journal entry. Cash goes out the door on the payment date, another journal entry. But the real trap for investors here is the ex-dividend date, which hits exactly 2 business days before the record date. If you buy the stock on or after this day, you get absolutely nothing. And that's exactly why you'll see the stock price magically drop by the dividend amount on that very morning.
Because dividends are a direct deduction from profits and definitely not an operating expense, the journal entry on that declaration date is super simple. You just debit retained earnings for the total declared and credit dividends payable. So until that cash actually clears the bank on payment day, that entire amount just sits there locked on the balance sheet as a current liability. Let's keep things moving with Section 4, the variations. This covers stock dividends and splits. So what happens when a company hands out extra shares instead of cold hard cash? Well, the whole thing hinges on one magic threshold, 20 to 25% of outstanding shares. Once you cross that specific line, the accounting treatment completely flips. Just look at the stark contrast here. A small stock dividend, so anything falling below that 20 to 25% mark, is recorded at fair market value. But a large one, from an economic standpoint, a large stock dividend acts exactly like a stock split. You're flooding the market with new shares, which naturally forces the price down per share, so recording that at fair value would be wildly misleading. Because of that, large stock dividends are recorded at par value only.
For a small stock dividend, the mechanics look like this.
You are essentially moving value right out of retained earnings for the full fair market value of those new shares. You're permanently capitalizing it into the stock accounts by crediting common stock for the par value, and then you just plug the excess right into APIC.
Now, you definitely don't want to mistake a stock split for a stock dividend. They are entirely different beasts. A split doesn't touch retained earnings at all, and total equity remains perfectly frozen. It just takes a cleaver to the par value, slicing it proportionally to match the new share count. And if you're analyzing these sheets, here's the crucial takeaway. Whenever a split happens, historical earnings per share absolutely must be retroactively restated. If you forget to do that, your comparative models are going to completely break down.
We've made it to our final section, Section 5, the edge cases. Let's talk about preferred and liquidating dividends.
Here's our first major analytical trap: cumulative preferred stock. Unpaid dividends, known as arrears, just quietly accumulate in the background. They actually don't hit the balance sheet as a legal liability until the board formally declares them. But, and this is a big but, if you're calculating basic EPS for common shareholders and you forget to subtract those hidden arrears, your math is completely invalid. It's a classic little mistake that companies sometimes love to, accidentally overlook when they're boasting about their earnings per share.
Finally, we have the liquidating dividend. If a company hands out more cash than its total accumulated GAAP earnings, well, they aren't distributing profits anymore. They are quite literally handing the investors their own money back. Because this is a return of capital, it reduces APIC rather than retained earnings. Though, the silver lining for the shareholder here is that it actually lowers their cost basis for tax purposes.
So, from the quiet power of those contra equity accounts to the really strict guardrails around dividend payouts, corporate equity really is a complex machine. As you review all these rigid mechanics, I want you to consider this. Knowing the strict golden rules that totally shield the income statement, how do savvy corporate boards creatively and legally shape their financial reality? How do they maximize shareholder value without triggering those SEC alarms? It's honestly the ultimate accounting puzzle. Thanks so much for joining me for this explainer, and I'll see you next time.